During the last 6 years, as I have dived deep in the world of investing and have had countless discussions with friends and family and colleagues about investing, I have noticed what I believe to be the most common mistake that every investor at one point makes, including myself for a good year or two in the beginning. That is to know what type of investor you are and follow a strategy that suits your style of investing. That might sound very simple and easy. And in fact, it may be simple, but I'd say it's easy to not follow a strategy that suits your style of investing. In this video, I will break down in more detail what the most common pitfalls are in regards to finding out what type of investor you are and picking what strategy to follow. I will of course also show you what you can do to avoid these pitfalls. Hello everyone, I'm Alex Valentine and I'm an investor nerd and a recent bachelor graduate with a major in finance. And on this channel I have the goal of spreading knowledge about investing in the stock market. But before we move ahead, I'm not your financial advisor, so if you feel like you need more assistance regarding your investments, you should seek out a professional financial advisor that can help you in your specific situation. But now, with all that said, let's get into it. So I want to start off with an almost embarrassing story about my first ever stock that I purchased. It was in this company called Cincino Holdings. Why did I buy this stock? To be honest, I can't tell you. Maybe because it rhymes with casino and I was feeling lucky, but honestly, I don't know. My colleague at work had just told me that I should get into investing in the stock market, and he showed me a graph of a stock that had just gained 1,000% in a matter of weeks. And we both just saw dollar signs in our eyes, and we really were thrilled to just get into the stock market. I don't really remember how I stumbled across Cincino, but it was the first ever company that I was reading up about and considering investing in. So this company was at this time focusing on healthy coffee drinks, and funnily enough, at this time I didn't even drink coffee. I was going through the CEO's notes about the future prospects of the company, and he really seemed to be excited with heaps of opportunities to grow the company and be more profitable. Which, in case you didn't know, pretty much every CEO says those kinds of things about their company. And it's only a rare few who speak transparently about the issues in a company. But for me, this really sounded great and I felt like I wanted to be in on the ride. So without doing any real due diligence or valuing the company to see if it was fairly priced, I purchased 28 shares at 17.92 Swedish kroner, or about $50 worth. And from that point, I consistently saw more red days than green. Not even a year afterwards, I pulled the plug and I wanted to get out and sold at about a 30% loss.
Just like my usual casino luck.
And then on a funny side note, the share price actually kept dropping for a couple of more years from that point. But since then, the company has actually shifted their focus towards supplements and the share price is up 1,000% in the last 2 years from its lowest point. Fortunately for me, I didn't have much on the line at that point, but it really taught me that I didn't actually know what I was doing. And if you just picked up investing in the last year or so, you may not have had the same experience as I had, as so many stocks this last year have had a great and positive return, which is all well for your portfolio. But you know what they say, you learn from your mistakes, so hopefully you can learn from my mistakes in this video instead, so you don't have to make the mistakes yourself and lose your own money when the market turns less kind again. So my mistake was not knowing what type of investor I was, and then that I didn't follow an investment strategy that matched my true investor style. So let me break down the two types of stock market investors there are. So that is to either be an active or passive investor. You may have heard of these two before, but I'll just break them down quickly so we're all on the same page. When I bought my first shares in Cincino, I acted as an active investor because I decided to invest in one specific company. Now, I did a very poor job in my first active investment, mainly because I didn't know what I was doing and I would have done way better as a passive investor. A passive investor is where you seek to follow the moves of the whole market. This is most commonly done through either an index fund or exchange traded fund, also called ETFs. The index fund's objective is to track a particular index, and an index is a collection of many stocks. The most common example is the Standard & Poor's or S&P 500, which actually contains 505 large American companies. There are a couple of different constraints for a company to be a part of the S&P 500. For example, the market cap of the company needs to be at least $13 billion, and their IPO can't be less than 1 year ago. So you know that these types of companies are really large companies that are well established. So every day some companies will trade lower and others will trade higher. And when you combine the moves of all of them based on their market cap and their size, you get the movements of the index. But the S&P 500 index is just that. It is an index. And you don't buy the index, but instead you can buy an index fund or an ETF, something like VOO, which means that the manager of that fund have the goal of matching the performance of the index. So they use the fund's money to buy the same proportion of shares made up of the S&P 500 to mimic the moves of the index. As this doesn't take that much effort to do, these funds usually have really low cost compared to an actively managed fund, which means that you can have access to the moves of the whole market without much effort and at a very low cost. This has previously shown to be a great strategy. Over a really long period, like we're talking 30 to 40 years, the S&P 500 index funds have returned about 10% per year on average if you reinvest a dividend. So just like there are passive index funds, there are heaps of actively managed funds, and these have the goal of beating a benchmark, which is usually something like the S&P 500 index. That means that the team behind those funds will actively analyze many different types of companies to find the best performing companies in order to beat the return of the market. As you can imagine, this is a more costly operation, and therefore actively managed funds usually have a higher fee than passive funds. So to make a fair comparison between index funds and actively managed funds, this is done with the return after the fees is considered. And actually, more times than not, actively managed funds is unsuccessful and they underperform their benchmarks. This is true in America, where about 75% of actively managed funds underperform their benchmark, as well as back home in Europe. And here in Australia, it's about 81% that underperform against their benchmark. So that means that you can beat most of the actively managed funds by spending a fraction of the time and instead investing passively in something like an index fund. It's where you get the biggest bang for your buck, or rather for your time. So if the professional active fund managers fail to outperform the index, is it even worth trying to do it yourself? Well, you should remember that one of the reasons that some of them underperform is that they have a higher fee than the index fund. So for example, if the fund returned 11% but also have a fee of 2% and the benchmark returned 10.03%, and an index fund like VOO, which has a fee of 0.03%, then the actual return to the investor would be 9% from the actively managed fund and 10% from the index fund. And the actively managed fund underperformed after fees, even though they picked stocks which outperformed the benchmark. But if you were to pick those stocks by yourself and didn't pay the management fee, then you would beat the index fund in this example. Another reason why I choose to invest in specific stocks that I have picked myself is because it can be really rewarding and a great feeling when you read up on a particular stock and you reach a conclusion on what you expect that the share price should be, and you buy in and you see how the share price is trading and moving towards your expected share price. And then finally, if you're successful in your research, you surely can beat the return of the index funds. But as any successful active investor would tell you, you must be prepared to have a losing year where the index fund beat you. And let me tell you from experience, it's not fun when you put in the work and the effort to your investment portfolio, and those who just bought into the index fund and didn't think twice about it, they just sail right by you and have a greater return and a greater year than you had. Even Warren Buffett, CEO of Berkshire Hathaway and one of the most successful active investors, have in the last 55 years since 1965 had 19 years where the S&P 500 beat the return of the Berkshire Hathaway stock. That's about 1 in every 3 years where Berkshire Hathaway didn't beat the S&P 500, and though they significantly beat S&P 500 throughout the whole period. So to now get to terms with what type of investor you are, we need to consider this spectrum between passive and active investing. So we've just gone through each end. That is only passive or only active. At passive, we put in the least amount of time and can expect our return to be equal to the market as a whole. And at active, we need to devote the most amount of time with a possibility to beat the market, but also a risk to have a worse return than the passive investors. And thus, we have a greater variance in our return. But in between passive and active, you could also choose particular sector-specific funds. For instance, if you think that the technology sector will continue to outperform the market like it has done in the last decade, then you could choose to invest in a technology sector-specific fund, which usually tracks a sector index. This way, you have actively chosen in what sector you want to invest in, but without taking the time to research and pick the companies that you think or believe to offer the best value within that sector. But with these types of funds, you need to do more due diligence than with your average S&P 500 index fund, as there are more actively managed sector-specific funds than passive. And then finally, you can of course do a bit of each. This is what I'm doing myself, and in my own portfolio, I have about 30% invested in index funds, about 20% in sector-specific funds, and about 50% in specific stocks that I have picked myself. There is no magic ratio there that I have worked to achieve, but rather that is what it has turned out to become. With a mix like this, I of course get very happy when my stock picks outperform the market, but in times when the index outperforms me and my stock picks, I can be at peace as another portion of my whole portfolio is now doing better, and I don't feel like I'm missing out on the return that the passive investors get. But now, if you are trying to figure out whether you should be a passive investor or an active investor, there are a couple of things that you need to consider. First and foremost, I'd say your time. If you have a full-time job and you have a family or maybe other out-of-work commitments, then trying to become the next Warren Buffett in an hour each weekend might not be your best bet, and I'd say maybe a passive investment strategy would suit you better. Then the second big thing to consider is your interest in the stock market and stock analysis. I would assume if you're watching this video that you have some sort of interest to invest in the stock market. But to be an active investor, you must have an interest enough to do a proper due diligence and valuation of the company to make sure that you are buying a good company at a fair price. So you don't make the same mistake that I did when I bought my first stock in Cincino. I mean, a good start is to at least be familiar with the product the company is selling. A final good thing to help you determine what type of investor you should be is your risk tolerance. As with any investment, there is always a risk to it. As you can imagine, if you act as an active investor and only buy a few stocks, then if one or two of these were to drop significantly, then that would impact your whole portfolio a lot more than if these stocks were a part of an index fund with about 500 other companies. Therefore, if you are a very risk-averse individual, then you might also be better off having more of your portfolio in passive investments rather than a few stocks. And not to say that index funds can't have significant drops either. I mean, if you are a really risk-averse individual, then fixed income investment products like bonds might be a good option to decrease the risk in your portfolio even further. There are a couple of tests that you can take online in regards to how risk averse you are as an individual in regards to your investments, and if you'd like, I can link to some of these down below. But there it is, the common mistake of not knowing whether you are an active or a passive investor, or like me, a mix of both. If you get this right, you will be well on your way to become a better investor and make better decisions for your investment portfolio for the future. That is, if you know that you are a passive investor and a friend recommends you to buy a particular stock, you may wish them well on the way, but tell them that that is not for you. You only focus on the index funds. Or if you are on the other side as an active investor and you want the thrill of investing, but you notice that the S&P beat you last year, well, now you know that that's just a part of the game. Whatever it may be, I hope that you felt like you got anything good out of this video, and if you felt like you did, please leave a like down below. It would really help me out a lot. Also, as you can tell, I'm still a pretty small channel, so leave a comment down below. Tell me what type of investor you are, if you're passive or active or both. I'll reply to every comment that I do get on this video. Finally, make sure you are subscribed to the channel and press that bell icon so you don't miss out when I release a new video. I have a ton of great content to come that you don't want to miss out on. But that's all from me in this video, and I'll see you in the next one.